Okay. So let me get back to my PowerPoint. So if nobody has any questions on payroll, we will go back to depreciation for now, and we'll plan to review, we can maybe go through any questions anybody has on this. I will have this up there by tomorrow, this study guide. And then if you have questions on the back of the book test, when you have those back, we'll plan to do that on Tuesday at the beginning of class. So if you have not scheduled your test yet, make sure that you do have that scheduled for after spring break at some point. I don't think it's not the week after spring break. I'd have to go look. I'll look at the schedule. We have one more week to review after spring break. So you have a little bit of time, but you want to get the spot that you want. So. Okay. All right. So we talked just about basic information on depreciation last time. Talked about the journal entry and what book value was. Okay, I think we were right here. Maybe. Okay, yeah, I don't think we covered this. So I don't know what, this doesn't show me the slide number. Let me see. Now this is only slide 5. Okay, I'm gonna start here. It seems like I was a little bit farther, but then I do that, and so now I'm nowhere. So we will review a little bit. So we got the journal entry. So GAAP depreciation is what you use for financial statements. Tax depreciation is obviously for taxes. So we did talk about this. This is something that is different. So tax depreciation can be used for both if you're not auditing the financial statements and it's not material, or it's not material. That does say or. So yes.
So I had a quick question for you about like writing things off and stuff like that. Why can't I write off like if I make a loan payment on my truck, why can't I write that off as an expense? Whereas if I'm leasing the truck, then I can write off the lease payment as business expense. That's what doesn't make sense to me.
So lease payments, you don't own the vehicle if you're leasing it. So
I see.
So you're just writing off an expense, and so you do not calculate depreciation then. So one, you're calculating, you have like a rent expense, and the other one you've got depreciation and interest that you're paying that you can write off. So
I see.
It's just different. You do end up writing them both off, but you write them off differently.
Gotcha. Okay.
So we already talked about this. So the information you need to calculate depreciation is the cost, the residual value, salvage value, scrap value, trade-in value, whatever they call it, the useful life, and what method you're using. So we will cover, I think, 4 different methods in this book. And we do get to start with the easiest one, with straight line. So when you calculate the cost, so the first number you need to know is what you paid for it. So that includes the purchase price, the transportation costs, any installation to set it up, and if you have to test it. And remember, land is not depreciable, but there are this list of things that would be included in the land. They would not be written off. They would be included in the cost of the land, and they would just go on your books as an asset. So downside is you're never writing those off forever. They're sitting on your books. They're an asset for you, but you're not getting the expense to write them off. Okay. This is where we ended. So we did not talk about improvements to the land. Improvements you do depreciate. So the cost of the land and all of those other things on that last slide, you do not, they just go into the cost of the land. Depreciable improvements decay. So they're going to go down in value and they're going to wear out. So things like a driveway, sidewalks, parking lots, if you redo those on a building, those would go into improvements, would be the name of your account. Fences, sprinkler systems, lighting in your parking lot. So a lot of this is the stuff outside your building, because it's not in your building, because it would be improvements to your building then. So this is improvements to land. So all of these things would go into a separate account and you would depreciate them. So they are recorded separately and wear out, but the land is not. So you just need to keep in mind the difference between the two and think about what wears out and what does not. So that was the land. The building we are going to depreciate. So there are things that go into the total price or the cost of the building. So the purchase price, brokerage commissions, sales, or other taxes. If you have to redo the building to get it to intended use, that goes into the cost of the buildings. Those are not written off either. So example, the last store that we opened, it was a empanada place before. And so we had to take out some walls, we put in new seating, there was all of these repairs that we did and renovating. Those were all going into this building account, or for us, it would be leaseholder improvements is what it would be called, but this is the same idea. You can't write them off right away. You have to put them in because you're not using the building yet.
Excuse me, Michelle.
Yes.
What about things like security system? It's to the building, but it's also, know.
I would say if you put it in before you were open, I would put it in this renovating. But if your business is open and you added one later, it would not go in your building, but it would still probably be depreciable because it would be probably expensive. You know, if you're buying something, an asset and it would last you more than a year. So I don't know that I would put it into the building account, but I would put it into, it would be equipment, probably. And then you would depreciate it from there.
All right, thank you.
Which machinery and equipment you can depreciate faster. So that would be, I guess, a benefit compared to putting it in the building account. So if you're buying machinery equipment, it's the purchase price less any discounts. If you got a discount on it, obviously you don't get to put that in there. Any commissions, freight charges, transportation to get it, any insurance to get it to you, any taxes to get it to you, and installing it and making it ready to use. So it's kind of the same. I think we already kind of talked about this, but you get it all when it's ready to use that piece of equipment. All of those costs are going to go into that equipment account and be depreciated. And testing is in there also. So that's kind of, this is the same list I think we saw before, but we're now talking specifically machinery and equipment. So sometimes you'll see a list where it'll give you a bunch of costs and you'll have to figure out, okay, how do I book this and which cost do I include in there? So this example, we purchase equipment for $60,000 cash. This is an easy one. So equipment is debited because it's an asset and cash is credited. So they just give you the whole dollar amount. You're hoping you're going to see one just like that on the test would be great. But if you do, there'll only be one. So if we purchase a building for $40,000 cash and 160 note payable, so this is, we did some cash down, some notes payable. So obviously the building cost us $200,000. We're going to put the building on for $200,000 and then part was cash and part was notes payable. So that's another fairly basic one, but there's not a whole lot of calculations. This one is, if they give you this question, this looks more like your homework. Your homework tends to ask you the more difficult questions. So how should they record this asset? So they give you a whole list of expenses. So the land they bought for $90,000, cash and 120 notes payable. In addition, they paid delinquent property taxes, title insurance, leveled the land, built a fence, put up a sign, and did some lighting. So which of these costs are gonna go into, we don't have any buildings here. So what's gonna go into that building or that land account? Which of these costs are gonna be part of that? So we've got 110, 90 plus 120 is 110, 210 so far. What about the delinquent property taxes? Do we
That
just
would go
write,
into the price of the land.
okay, because they're delinquent is the key word. So now we're at, let's see, we said 110, 112. We'll see if I can
Two
remember.
hundred
these.
and 13. 200.
200, oh, yeah, I'm glad you're doing the math and not me.
No,
200
222, because I didn't do it right.
120 plus
Yeah.
90,
It's 210.
210, 212.
Mhm.
Plus your delinquent taxes. Maybe we should just go to the next slide. It'll do the math for us. What about title insurance? Does that go into land?
Yes,
Okay, so we're gonna add that. We're not gonna do the math. We'll just say yes. Leveling the land. Is that a yes or a no?
that's a no, it's an improvement.
I think it would depend on if you need to level the land to build
Do
on it.
anything. I'm
Probably
gonna
yes.
Say yes, unless they gave you more information. So, because you're leveling it, then you're probably gonna build a building is my guess. Your fence,
Wait, so it goes under land, we do?
yeah,
Okay.
Okay.
there, yeah, the next slide tells us the answer. What about the fence and the sign and the lighting?
No.
They're nice. They put these in order for you. These three are all the improvements. So if we look here, they've got the property taxes, the title insurance, and leveling the land. Those are all going to land. So if we added all those up, that would be the land. And then the other three, the fence, the sign, and the lighting, think of these things are gonna run out, they're gonna wear out. Leveling the land, that's not gonna wear out. It's not gonna go into a different account to be depreciated. So all of these things are gonna wear out, and we're gonna depreciate them. So if we put them in, oops, one too many, put them in our journal entry. The land is 219, so that's the 90, the 120, the 2,000, the 2,500, and the 4,500 is right here. The land improvements are these last three, and those are right here. And then they said we did the notes payable for 120. It says that they pay for these things, so that's why that is part of cash. I don't like the way, in reality, you're not gonna write, that to me looks like you wrote one check for 178,000, which is not true. You probably wrote 5 checks here, one to the bank when you bought it, and then all of these other things. They have you writing one check, but that is the way most accounting tends to work in the textbook, instead of just writing separately. You know, if you were in QuickBooks, these would each be separate entries. Does anybody have any questions on any of these things for how to break up the costs? Okay, so the next section is a group purchase. Sometimes it's called a basket purchase. This is when you buy 2 or more things for one price. So buying a land and building is most common, but also if you buy a business, it could be also. So we're gonna need to allocate them, allocate what we paid for it between those different assets. So we're going to divide the fair market value by the total. To me, this makes no sense. You got to see an example. So we'll look at it this way. So we're gonna buy a shop and land. So we got a building and land for 110,000. So they have to tell you how much you paid for it. And then they're going to also tell you what the fair market value is. So they would have it appraised. So they're saying it is worth 150,000. That's the fair market value, but they're getting a good deal on it. That definitely would not happen in our world right now, but we'd probably be paying the other way. So the first thing we need to do is we're going to, I guess here's the formula for each of them. So we're going to put on the top is going to be the value of the land and then all of it together to get a percentage. This is not the way I normally look at them. So we said the land was 90,000 is what it was worth. The building was worth 60. So you add those together and then we're going to divide the 90 by that. So 60% of the cost was for the land and 40% was for the building. So realize in the end, you have to come up to 100% because all we're doing is allocating that the 150,000 value between those two assets. So then we're going to take that 60 and that 40. And we're going to multiply it by how much we actually paid. So we paid 110. So 60% of the 110 that we paid is 66. That is the amount we're going to put in the land account. And then the 40% of the 110 is what we're going to put in the building account. So when I write these out, I tend to write them out in a different format just so I can see it. But this does work. This formula here is the correct formula. So it's the value of one asset over the total, and value of the other asset over the total. And you could have several assets there. If you were to buy a business that had several pieces of equipment, something like that, you could allocate it the same. So our journal entry, I don't think it's going to give me a journal entry. My journal entry would be a debit to land, a debit to building for these two amounts, and the credit would be the 110 to cash or notes payable, whatever, however we paid for it. All right, so here is a nice review. We talked about costs. Then we have not done anything with residual value yet. So that is the next piece that we need to talk about. So remember, it is the value the company would recover from getting rid of it at the end of its useful life. So if you were to trade it in, if you were to sell it used, whatever that is, whatever that residual value is. A lot of times it's zero because it's really not worth anything and you're just going to donate it or something or throw it away. You do need to know the definition of depreciable base. That is the amount that can be depreciated. So cost minus residual value is the depreciable base. So sometimes they may just give you, they'll say the depreciable base is, so you need to make sure you know what that definition is. You cannot depreciate it past its residual value. So the most you can go down is down to the residual value. So say residual value is 1,000. When you're done fully depreciating it, that will still, it'll have $1,000 book value left on your books. So whatever that residual value, that should be your ending book value until you get rid of it. So that's residual value. Useful life. One thing is we don't have to figure this out. They just tell you what it is. So it is the estimated years the asset will produce in your business that you'll be able to use it. Or it could be the number of units. So how many miles is it going to drive? How many items is it going to make? It could be hours also. If you're talking like a loader runs on hours, it doesn't run on, it doesn't go by miles. So some equipment goes by hours. So you will be told what that is for your problem. And then the last one is the method used. That is what the rest of this book is about, is using each of the different methods. So we have 4 of them that we're going to do. Straight line's the easiest. I would say these go in the order of difficulty. So straight line is easy. Units of production is a little bit harder. Double declining balance is the most confusing, I would say. And some of the year's digits you probably have not done, and nobody in real life uses it. So that one is hard in that you haven't used it before and it's something new to learn. So it's not a difficult method, but you do have to, you have to figure it out. These 2 are accelerated methods. So you're taking more of it up front. So you're getting more depreciation right up at front. These 2, this straight line, you're getting the same amount every year. Units of production goes by how much you use it. The more miles you drive, the more depreciation you're going to get. So I I would say this is probably the most realistic on how fast it wears out, just because the more you use it, you're gonna take more depreciation and the faster it will wear out.
So another quick question on that. So with straight line, do we say, okay, the car depreciates this much for this amount of driving or something like that?
Nope, straight line, you would just say, I'm gonna take it and divide it over the 5 years. It's gonna last me
Oh,
5
okay.
years.
So how do I depreciate by units of usage? Like, again, how many miles I drive the truck?
It would be miles. So if you decided on this, it would be, you're gonna say up front, my car is gonna drive 100,000 miles, and then we're gonna get rid of it. And so then just however many you would depreciate on that basis. So you would just have to
Okay.
know how many miles it's good for.
Okay,
Hopefully
and
more
then,
than 100.
but even if and then if I sell the truck when it hits 100K, but it's still a functional truck, would I just but somebody else gets it and they're happy to take it, would I just record a cash debit on the sale of the truck?
Yep. So even when you talk about useful life or miles, if you're talking units, this is an estimate. So, you may estimate $100,000 miles on a vehicle, but when you may drive at 200,000, but when it hits the 100,000, it'll be fully depreciated. You just won't have any more write-off. And
Okay, so
you could just keep driving it, or if you decide you're going to sell it or give it away or whatever, that's fine. You may just repair it and keep on driving it forever. I have one of those. So,
because it's like, I don't know, I've seen businesses do this, and then what do you know, the truck gets to 1,000,000 miles, so they can just, because they drive the thing 100,000 miles a year for all the driving they do, so it's like they can just stop worrying about book depreciation after the first
Yep.
year and just
Yep.
keep driving the truck.
right. So whenever they hit those mileage, then so it would be the same as when you hit the 5 year straight line, whatever, then you can't depreciate it anymore because you would have depreciated the full amount. And it doesn't matter which of these methods you use, you're going to get the total is going to be the same. You're going to get down to that salvage value at the end of whatever life you've decided, or miles, whichever one you go with. Let's see, it's 1224. We'll do straight line because it's the easy one. So it's cost minus residual value over the life. So these formulas, this one you need to probably memorize the formula. Some of them, I don't know that they have as much of a formula. You just need to practice, I would say. So this will give you the depreciation for a full year. So just make sure that you read questions very carefully on, are they looking for the annual depreciation? Are they looking for a monthly depreciation? What it is that they want. So this is the way that all of the textbooks teach you. The other thing is you calculate a percentage, and I have seen questions where they ask you, what is the depreciable percentage? I think is what it says. It's going to give you a rate, or what is the annual depreciation rate, I guess is what they say. So you're going to take 1 and divide it by the useful life. That's going to give you a percentage. So say it's a 5-year vehicle, 1 divided by 5 is 20%. That means you're going to take 20% of the cost each year, which is the same thing you're going to get if you do it up here. But sometimes they do ask for that percentage. I'm pretty sure there's a couple of questions like at the back of the book test and on the quizzes that ask for the annual depreciation rate. So rate's looking for a percentage, expense is looking for, what am I going to take for this year? So this example, we paid $25,000 for it. Useful life was 6 years, residual value of 1,000. And they are very nice with their math, if you notice, because this math we can do in our heads. So if they want the annual depreciation expense, we're going to take 25,000 minus the 1,000 divided by 6, should give you 4,000 a year. So that's your annual depreciation rate. If they wanted to know monthly, we're going to then multiply that by 1/12, and that would be a monthly depreciation rate. The other thing to be careful with when you're doing these problems is when they purchase the asset. So they're kind of nice on the first ones here. They just say you bought it January 1st, but in real life, you buy them all throughout the year. So you're going to have to look very carefully at what date they bought it and calculate the depreciation from that date on. And we will get to one of those. So remember, our entry is depreciation expense is a debit and accumulated depreciation is a credit. And they are just recording an annual depreciation. And they're not, they don't even give the question. So it would be nice if they had the question here that says, oh, it does say each year, what is the adjusting entry? So they want a yearly amount here. When you put those into your T accounts, remember this equipment account never changes. We paid 25 for this. It's going to stay at 25 forever. What's going to go down is the book value, which is the difference between equipment minus accumulated depreciation. If you picture your balance sheet, it'll say equipment and then it'll say accumulated depreciation, and then it would have a net number. So each year this number is going to go up by another 4,000 as we take the depreciation. And so after year 3, we had taken 12,000. So our book value at that point is equipment less your depreciation. Our net value is 13,000. Or if it asks you, what is the book value of this after year 3? Your answer is going to be 13,000. So a lot of these, it's going to be the same problem with the other test that you took, is just reading the questions very carefully. What are they asking? I tend to skim the question and then I do a whole bunch of work, and then the question they were asking was a very simple question that I didn't have to do all that work for. So it is beneficial to actually read the question, figure out what is it they're looking for, and then do the work for that. So here is when we have to worry about dates. In the year that we buy it, you're going to depreciate it for only part of the year. So we're going to prorate it. GAAP allows the use of any reasonable, consistent method. So that's just their definition. So you could do months. So when if you go and read like the annual reports from businesses, there'll be a section in there that tells you how they calculate the depreciation. So if it just says that they calculate it by month, then they can do that. So they could say, and a lot of these ones do, they say, if we buy it before the 15th, we're going to depreciate it for all month. If we buy it after the 15th of the month, we're going to say that we bought it the first of the next month. So in the end, it's not exact to the day, but most businesses don't go to the day. They're going to go by the month, and they're going to either say before the 15th or after the 15th. So most of your problems will have this wording in it. So you'll have to know, oh, if I bought it on October 15th, normally they won't even give you the 5th. Oh, it does say on or before the 15th. So if they say October 15th, that is on or before October 15th. So I'm going to count all of October, November, and December. So I would have 3 months of depreciation there. If it was after the 15th, it was October 16th, I'm only going to have two months of depreciation this year. So I don't see a date yet, but we know it's 5 years, 17,000, residual value is 2,000. So if we do the math, we know that our annual depreciation is $3,000 a year. And what if we purchase it March 12th? I'm assuming they're not clear here. In your problems, it will state that before the 15th, after the 15th. If we buy it March 12th, that's before the 15th, which means we're going to count March. So you've got March, April, May, June, July, August, September, October, November. You got 9 months that you're going to include. So we're going to multiply this by, oh, did I count wrong? Look at that, I counted wrong. March, April, May, June, July, August, September, October, November, December. It's 10 months. I tend to count on my fingers when I'm counting months because I don't want to mess it up like I just did, because I would have done 9/12 would not have been right. And it probably would have been one of the answers. This is 10 months because I'm counting March to December. So I'm going to multiply this 3,000 by 10/12, which says that I'm going to take 2,500 this first year. The second year is going to be all 12 months. So I get the full 3,000. And so then it would go for 3,000. So one thing to realize here is that this is a 5-year asset. It doesn't give us a year. So say this was March of 22. We're going to depreciate it for 5 years, but they may not match our calendar year. That first year, we're only taking 10 months. Then year 2, we would take 12 months, year 3 is 12 months, year 4 is 12 months, year 5 is 12 months. And then there would be a year 6 where we get those other 2 months, that January, February. So even though it says 5 years, you're going to take some of the depreciation over 6 calendar years, because 5 years means 60 months. So it doesn't always match up with your calendar. What if we buy it July 17th? I'm going to let you guys tell me how many months. See if you can count better than I do.
Five months.
Okay, so 5 months. We're not going to count July. We're going to start in August. So we're going to get 5 months. So we're going to multiply by 5/12, which gives us $12.50 for our depreciation for that first year. So the good thing about the test is it is multiple choice. So if you screw up your math a little bit, it's okay. If you don't count your months right, though, it'll probably have your answer. You know, if you say it's 5/12 instead of 6/12, they're going to give you both of those because they're going to assume you don't know whether I go forward a month or back a month. So thankfully, with multiple choice, some of your errors, you'll just come up that it doesn't match anything and you'll know, oh, I got to go do it again. But if you do it the wrong way that they expect you, the most common mistakes, then your answer might be one of their choices. All right, depreciation schedule. You will not have to fill one of these out. But if you've worked in a CPA firm or with a tax software, it prints all these out for you. You don't do any of this by hand. You just go and enter all that data in there and it does it all for you. But you do have to, know how to do it so that you can see if it's reasonable. Because if you input something wrong, it's going to come out with a number, or you're going to have a client ask you, why is it this? And you have to be able to explain it. So that is why we do it all by hand, so that we do understand it. Let's see. So we have all our assets listed here. We've got the date we bought it, what method we're using, the life or rate, the depreciable base, and residual value. So all of those things will be in there. Land does go on the schedule, even though it's not depreciated, because we want our total down here to match our total assets. So that's why it's put in here, even though we're not going to depreciate it. So all of this information is the information you need to calculate your depreciation and the information you will need to keep. So when you put it in your system, you can get one of these nice little schedules out, and it tells you the cost, the residual value, and the life in order to calculate your depreciation. So the example, annual depreciation on the office building is 30 years, $300,000. We do have a residual value here. I don't know if they didn't do the math, or let's make sure they did their math correct. Unless it's the first year of operation, add a column for depreciation taken before this year. So you're going to have depreciation in prior years or the accumulated depreciation before, so that you have a total. So they had taken 90,000 before. So 300 minus 100 is 200 divided by 30. I don't know where they got 90, but that's okay. They bought it on January 5th, so they should have a full year. Let me see if their math, if that comes out. Calculator on your phone's nice, but it always takes me a long time to find mine. So we have 200,000 divided by 30 years is 6,000 a year, $6,666.66 per year. I don't know where they got 90, but we're not going to question that at this point. This just wants you to know how to fill out the schedule. These two are fully depreciated. So if we look at that, if you had to look at one of these and answer a question, the base is 90,000 and depreciation in prior years is 90,000. So we're not going to have any new depreciation this year. On both of these, you can tell that they've taken all of the depreciation. And then there's a current year depreciation column. So this year we're gonna have $10,000. See, they're not taking anything. Oh, see, I'm reading it wrong. See, I did it wrong. Sorry. If you don't read carefully, you mess it up. This does say depreciable base. It does not say cost. I'm used to having one set up that has the cost, not the depreciable base in there. So they've already taken, they paid 400,000 for it. They've already taken this 100,000 out. That's how they get their math to work. So sorry about that. So each of your assets that you are still depreciating is going to have a depreciation amount here. And then that would give you your total down there. And then we have a new accumulated depreciation, which is prior year plus this year. So now our accumulated depreciation is 100,000. So this should match everything on your financial statements. And if you added up the depreciable base plus the residual value, that would should add up to your total assets. So those are ways just to check them. So as far as this goes, you just need to know, I think I've seen like one question is more a theory question. So if you're in manufacturing, then part of this is being charged differently. It's being charged to manufacturing. It's not being written off, but you don't have to be able to do it because we don't cover that in this class. But you do need to know in manufacturing, part of the depreciation or a percentage of it would go to the manufacturing account. So this is our basic journal entry that we do. So we know this one. Manufacturing, the difference between it is it's going to work in process inventory because we're in manufacturing, we're building something and then we're going to sell it. So we don't get to write off that depreciation on it until we finish it and sell it. So you just need to know that it's going into this work in process inventory. So you may see one problem like this, but you don't have to do a whole lot of calculations or anything. So just realize if they say the word manufacturing, they're going to have a work in process inventory that is going to instead of your expense account. So we'll see. I think there's like one question that you'll see on that. But as it says, allocating it is beyond the scope of this course. So I think I have seen one question where it's more theory based, that you don't have to really know how to do it. And then if we go back to here, this just gives our totals that we have again. So they're adding these two together and their property, plant and equipment should be at 847. And this is the accumulated depreciation at the beginning of the year. This is your depreciation expense. And it looks like they've allocated some of it to manufacturing. So I would not worry about that at this point, but this should match your total expense for the year. And then this last one should be your accumulated depreciation. That should match it also. All right. Does anybody have any questions on straight line or any of that? Or is your head still in payroll? That's the one thing is you get in between these and it's like you can't think about two things at once. But we do need to make sure we keep reviewing payroll. And actually, I think it'll work out better for you when you test. So let me, I think you should still.
Michelle, I have a question on the homework in the I'm sorry, my brain is just mush today.
None of my stuff is opening. I have got an error. Can you guys, when you go in, any of my attachments, for some reason that's down, because they're like my syllabus and schedule is gone. When I went to look for the homework, I couldn't access it. So I don't know if it's just me. Or it may be something is down at Blackboard or at whatever world.
Mine is showing up. Mine
Okay.
is showing up.
Okay, good. If somebody's,
Mine is-
I have it saved somewhere else so I can find it. You're looking at depreciation homework?
No, sorry,
Payroll.
on the discussion board,
Oh, yeah.
when we click on it, it's still going to the 6.06 discussion. So,
I think I just fixed it,
oh, okay.
but let's go and look. Because somebody else said that, and I think I went in.
It's still saying 6.6.
Can you see my Blackboard screen?
Yes.
Oh, okay,
You
so
might,
if I
you
go
might
to-
need to refresh. Mine's linking to the 8.06.
Okay, I would try to refresh, because when I go to module 8, discussion, class discussion on, oh, the 8.0, this one, you know what, the other one I might not have fixed. So that one goes to the right place. The responses, I did not go in and look at that. That one's probably wrong. Class discussion responses. This one is wrong. So I will fix that one. So you should be able to see 8.6 now. Let's see.
Yes, I just confirmed. Thank you.
Okay. Okay. So
Can
now,
anyone else see the homework attachment? Because mine's not pulling up for some reason.
you know what? Mine did not come up and I think I deleted it to put it back. So let me, let's see, I will put it back there. I will just put a link right now because I can do that fairly quickly. Oh, okay, so it goes in here. Okay, I will, I should be able to find it here. I will put it back there because it's kind of hard to do it if you can't see it. I'm glad you asked because I deleted it and I was going back and I had not done that. So depreciation, homework. Okay, there is a link there. I will go back and embed it in there. But right now you can click on this and open that Word document. All right. Anybody have any other questions?
Michelle, I just wanted you to check the board to make sure that, the discussion board to make sure that
Oh.
you,
I can see them all? Okay,
yes.
let's see, we go back to modules. And in class Thursday. All right, so I see 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. They are all there. So yes, I can see everything. So
Okay,
I
great.
will go through these and I will put them into a document, but you know, if you're studying, if you want to review payroll before that, you can just pick a section and go through and review the first couple sections. And then I would go in, what I will do, I don't know where to put it. I will put a practice quiz in. Let me see, I'll put it at the I'll put one at the bottom of module 8 so that it's there right now. So down here, 8.12 will be a practice test. So that you can take it and it won't count for anything. So that way you can have practice on the different multiple choice questions. And I would suggest just going into it every once in a while. I'll put like 10 questions in there so that, you know, you could sit down for 10 minutes and do it. If you could do that every day, life would be great, or 4 or 5 times a week between now and the time you test. By the time you test, you would know every answer on there. So hopefully you would understand them and not just memorize it, but I will do a practice test in there. I'll probably put one in next week also. I'll just keep one in there so you can find them. You don't have to go digging for it. All right. Look at that. We were right on time. So, all right, you guys have a good weekend. Right now, it is beautiful outside. I hope it stays that way.
Thank you, Michelle.
Thank you, Michelle.
Have a good weekend.
Thanks. Bye.